morning, students. Tomorrow we discuss about the capital structure, and today again the same topic is there, but the different factors are present. As I told you yesterday, that there are certain factors, there are many factors which affect the capital structure. So today we will discuss about these 8 factors which are present in your books or may not be there, but you should know about it because it is an important part of financial management. If you know about it, then only you comes to know about the capital structure properly. If you have any problem, you can ask it. You can ask on my personal number, as I told you. So you should watch the video carefully. Then only you will get it properly. So before starting the topic, I'm going to revise the meaning of financial management. So the first thing is financial management, and financial management is related to the proportion of uh, debt and equity in the company, and also we can say it related to the acquisition and allocation of fund in the organization. And financial management helps the organization to get financial support from outsources to fulfill all type of financial needs of the organization, so that the financial management plays an important role for the development of the company, and also it helps in providing the fund at the time of requirement in the organization. If the management provide the fund, then only the operational and other activities of the management can be perform smoothly in the organization. If there is lack of finance, shortage of finance, then ultimately no any work will be performed properly in the organization. So that the financial management plays an important role. And as I told you yesterday also, it helps in fulfilling the fixed capital and working capital requirements of the company, as fixed capital requirements are related to the availability of related to the fixed assets, and working capital requirements are related to the daily needs of the company, and it can be fulfilled by the financial management only. So the financial management plays an important role for the development of the organization, and it is also considered the lifeblood for the business, because whenever the fund is required, it can be made available by the financial management. Now the next topic is capital structure. As I told you yesterday, capital structure related to the uh, proportion of debt and equity in the capital structure. Debt is considered as a borrowed fund, and equity is considered as an owner fund, which is invested by the businessman himself. So students, just look at this. Look at these factors. Note it down these factors in your fair notebook. Okay, students. The first factor is cash flow position. Cash flow indicates the inflow and outflow of money from the organization. If more inflow take place in the organization, that's mean the company is getting more profit from the economy. And if more expenditure, more outflow take place in the organization, then ultimately the company is facing lot of expenditures. So that at the time of more income, the company prefer to use more debt in the capital structure, as I told you many times. And if the company is facing more expenditures, then ultimately they have to employ more equity in that particular capital structure. So if the company is going to employ more equity in the capital structure, then the capital structure may be strong, because the owner fund is more helpful for the company to be invested and to perform the different activities of the business. The another one is ICR. ICR means interest coverage ratio. Interest coverage ratio, as I told you people, ICR indicates the number of time the company earn before paying interest and taxes. So if the company is getting more profit and they are not paying interest and taxes, then it will considered as ICR. And people, every organization has to pay taxes once in a year, once in a accounting year, but the company can earn many times in a year, like 12 months are there. So if company is getting profit in 8 months and the company face for loss in 4 months, then ultimately the ICR will be calculated over the 8 months only. That is why we can say ICR indicate the number of time the company get profit by before paying interest and taxes, and it is an important part through that the company can calculate its profit also. The another one is DSCR. DSCR means debt service coverage ratio. It is just advanced version of ICR, but in DSCR the company also indicate the number of time the company get profit before paying interest and taxes, but it also include the principal amount invested by the company. Listen it carefully, because it is a basic difference between ICR and DSCR. That ICR indicates the number of time the company earn before paying interest and taxes, whereas DCR indicate that number of time the company get profit before paying interest and taxes, but it also include the principal amount. It also include the principal amount invested by the company in the business. So DSCR is quite different from the ICR. The next one is ROI, that is called return on investment. Return on investment also helps the management to identify whether the company is able to employ more equity, whether the company is able to employ more debt in the capital structure before starting it. In ICR, if company get more ICR, then ultimately the earning of the company will be more, and in that particular condition the company want to employ more equity, more debt in the capital structure. In DSCR also, if more DSCR take place in the organization, then company prefer to use more debt in the capital structure, because in that particular condition the company is able to pay interest and taxes on time, so that at the time of high DSCR the company prefer to use more and more debt in the capital structure. In ROI indicate the that how much the company is getting after invest a particular amount in the business. If company has invested rupees 1 crore in a business and the company is getting rupees 1 crore 50 lakh in accounting year, then ultimately the project is profitable for them, and the company prefer to get to do more and more investment in that particular project. And also the people, those have invested their money, they want to continue invest their money in that particular business. So if high ROI take place in the organization, then company prefer to get more and more debt from outsourcer, and the people also want to invest their money in that particular business which is more profitable for them. So ultimately we can say high ROI, in which the company prefer to employ more debt in the capital structure, and less ROI, the company prefer to use more equity in the capital structure. The another one is cost of debt. In cost of debt, we should analyze the economic conditions in which we have to we should know about that at what interest rate the financial institutions are ready to provide us debt facilities. In that condition, we also analyze the different type of things which comes under the cost of debt. If cost of debt is higher in the economy, then the company prefer to use more equity in the capital structure. Whereas if cost of debt is less, then the company prefer to use more equity in the capital, more debt in the capital structure. So that we can say cost of debt also helps the businessman to identify whether the project will be profitable by using more debt in the capital structure, whether the project will be profitable by using more equity in the capital structure. Then the another one is cost of equity. If cost of equity is more, then ultimately the businessmen prefer to use more debt in the capital structure. As I told you people, if if the cost of equity, that's mean the company is facing lot of charges for issuing their equity shares, preference share in the market, then ultimately the company prefer to use debentures, public deposit and intercorporate deposit instead of using equity shares. So ultimately we can say cost of debt and cost of equity also very helpful for the businessman to choose whether they will use more debt in the capital structure, whether they will use more equity in the capital structure. The another one is flotation cost. Flotation cost, as I told you earlier also, flotation cost is a type of cost which arise over the issuing of securities in the capital market. If we are going to get financial support from financial institution or commercial bank, then we have to pay some type of file charges and some type of commissions to them, then only they can sanction the loan to us. So that type of cost is considered the flotation cost. Or if flotation cost is more in the economy, then the businessmen prefer to use more equity, and if flotation cost is less, then the businessmen prefer to use more debt in the capital structure. The another one is financial risk. Whenever load of risk is arising for performing the business activities in the economy, so in that particular condition the businessmen prefer to use more equity in the capital structure, because risk is considered an important part which can be reduced, but it cannot be eliminated. So the businessman has to focus over the financial risk also, in which if more risk take place in the business, then ultimately the businessman has to use more equity in the capital structure. If less risk takes place in the economy, then the businessman has to use more uh, equity in the more debt in the capital structure. So student, these are the several factors which affect the capital structure. You should look at these factors. If you have any problem related to it, then you can ask on my personal number. I will send the notes related to it also. And again, I am telling you the full form of these points. ICR stand for interest coverage ratio, DSCR stand for debt service coverage ratio, ROI stand for return on investment. As I told you people, these points are very important related to the capital structure. I will send you the notes related to it. You should prepare the notes and try to solve the 5 questions which I'll give you in the notes. So you should watch the video again and again if you have any problem, and tomorrow we will discuss some of the numericals which comes under the capital structure. So it's enough for today. Have a nice day.